The Money Show. Personal finance.
A few things, Warren Ingram from Galileo Capital. Let's talk about the budget 2023. A couple of things came through which I thought were quite positive. The two-pot retirement system, that's quite a biggie in terms of the confirmation that you are going to be able to access part of your retirement and keep some for later. This sort of emerged during COVID, and people were wanted to access retirement funds and couldn't, and people were resigning from jobs in order to access retirement funds. So this is progressive. It's good.
It is, and it's a multi-decade problem that's been a huge source of loss of wealth in our country, because people get into deep financial trouble and they quit their existing job with the hope that one day they'll get another job, and that they in the interim can access their retirement fund. They give away anything from kind of a third to a half of it to tax, and they pay off their short-term debt, and they're stuck with no job, because that's how life works. Unfortunately, you get bad luck compounding itself, and so this two-part thing is something that's been in the works for a very long time, and so the fact that it's now getting traction and we're getting dates, where the minister said 2024. Really good, and for people that were worried about, they kept saying they are going to attack our pensions and they are going to do this and prescribed assets and all of that. It's the other way around, right? Because we've had a relaxation of exchange controls within retirement funds. They're allowed to invest a lot more, and now accessibility to your money in small portions, and so a really good move. I think and all we needed to see here was traction, that it's not just lip service a year ago and disappears. It's still going. So I think it's a very, very good move.
But also, when you look at something like this, if you're somebody who feels like you need to access your retirement funding, it's really got to be as a last resort. You've really got to have had a big problem or be really short of cash and not have the prospect of the way out in order to get early access to retirement funds like this, because ideally you want to leave them locked up as long as possible.
Yeah, and certainly, this is kind of the last chance to lose. This is the very last resort. This is not your, I want to go on holiday money. This is my family are going to lose their house money. That's when you do it. But the truth is that in our country, with everything that goes on, access to at least a bit of your retirement money, and it will be a bit. It's not going to be everything. It makes a lot of sense to me.
And also remember that this particular advantage is going to be added to whatever income you have. So if you're earning 100,000 Rand a year and you want to access 100,000 Rand out of your retirement savings in order to fund that short-term emergency that you referred to, you're going to be taxed on the 200,000 Rand income because it counts as income. So your tax rate's going to go up, and so you're not going to get the full benefit of the 100,000. So you've got to be very cautious and take some good advice on this before you go and think, woohoo! I can access some cash.
Yeah, my view is this is going to be a topic we will need to cover properly as it gets, closer. When it gets closer. Yeah.
The other one that was quite a big and progressive move also, because for years, I think it's when you turn 55, you can access 500,000 Rand of your retirement savings. I don't know why that exists, but you can. Yesterday, that was up by 10% to 550,000. That was quite big.
Yes. So the thing is, you retire and you're allowed to access a portion of your retirement funds tax-free.
You don't have to be retiring, sorry. You can access regardless of whether you're retiring or not, isn't it?
No. So this is that 500,000 is the lump sum you're allowed to access at retirement. So there's another dispensation. Okay. So and you're making me second guess myself as I'm speaking, which I shouldn't do. But this is about that lump sum on retirement and how much of it can be tax free.
All right. Tax brackets also moving, which is good. Your first 95,000 Rand odd for non-retired people now is tax-free. And then after that, everybody starts paying some tax. And the higher you go up the earnings tables, of course, you pay more. And I was actually just looking at those tax tables, and the one that jumped out at me was the 1.5 million Rand, which was where the new marginal tax rate kicked in of 45%. That's moved all the way up to over 1.8 million over the years. It's actually, you kind of get in your mind that the marginal tax rate kicks in at 1.5. Actually, it's incrementally has gone up quite significantly since it was imposed.
Yeah, I hope the commission is not listening, or from SARS, because we don't want to highlight this whole thing. I think it's always an easy perceived tax on the rich, right? If you earn, you should pay a lot more tax, and I think so I think kind of treating everyone equally fairly by moving these things as a percentage is exactly the right move, as opposed to being prejudicial to one group in South Africa against another in terms of who earns what.
Yeah. Anything else in the budget from a personal finance perspective that you want to pick up on? Those are the things I picked up.
My wish list was just that we would be able to add a bit more to tax frees. I think it's a pity that hasn't gone up.
That's still stuck at 36,000 a year. Yeah.
And that lifetime limit of 500,000.
Yeah.
That's really the thing that I wanted. And just beyond that, just really well done. I think it's it's very hard to give compliments in a state like this, but I think I was desperately worried that we were going to see an increase in taxes, especially personal taxes and especially wealth taxes. It just felt to me like the time was ripe for them to do something politically expedient, and they took the hard step, and I think that for me,
they did have an extra windfall of 93 billion that they weren't anticipating this time last year. Perhaps when that runs out of steam, then you start pickpocketing taxpayers.
I'm not biting. I'm going to stay positive and say well done to them, and I'm glad that they did it, and I hope it's a trend, because the next step must be a reduction again in corporate tax. I think that's important. If we want the economy to grow, want to create jobs, you've got to make it attractive for business. But I just want to say, all round, well done. I think this was a good budget.
I'm going to take your temperature before you leave the studio. It is also that time of the year, of course, where you are coming to the end of an opportunity to maximize any benefit that government does give in terms of tax incentives. So to top up those tax-free savings accounts, to also make a contribution to your retirement annuity.
So the tax-free savings accounts, it's 36,000 a year, 3,000 a month. If you haven't done it and you've got the capacity to do it, you haven't got many days left, please do it. It's one of the very few gifts we get given, and it really is tax-free, and it really is a no-brainer to kind of build up your investment. So definitely, I think tax-free is a big issue. And then for retirement fund contributions, we can do up to a maximum of 350,000 in a year, where you still get the tax benefits. And if you are earning a very big taxable income, stop paying extra tax. Why don't you make a contribution to a retirement fund? You're allowed to do it, and you pay yourself first in a way, and don't pay excess tax that you don't need to. Give yourself the tax break you're allowed.
And that big benefit, as you mentioned earlier, and let's just re-emphasize it, those retirement funds are now allowed to invest considerably more of your savings globally and make better global choices than perhaps they were more restrictive previously.
And it's now a 45% offshore allocation, which is big. That's material. And the other thing, there was this discussion around infrastructure as well, that they made it more easy for retirement funds to invest in infrastructure projects. And we hear about bid windows 6 or 7 or whatever it is for power plants, wind power or solar power. Those are working. Those things are happening, and retirement funds are making money out of those. So actually, South African retirement fund investors are benefiting from the energy crisis by making sound investment decisions now. Maybe it's being done on their behalf, but it's also something that's not being spoken about. So, these kind of retirement moves are really good. I'm really happy.
Warren Ingram from Galileo Capital is with us with personal finance. If there's something in the budget that you spotted that you don't understand, that you need translated, or something that you would like to be included in next year's budget, and Warren can toy for you at the Union Buildings or outside National Treasury. He's not fussy. Will give us your thoughts this evening on 011 883 0702 021 446 0567.
The Money Show. Personal finance.
So, taking advantage of the end of the tax year is a very, very important thing to do, Warren Ingram, in addition to retirement annuities and maximizing the amount you can do. It's a maximum of 27.5% of your taxable income, or 350,000, up to 350,000 rand. So if you're earning 100,000 rand a year, you can't put 200,000 rand into retirement annuity. You could do a maximum of 27,500 if you wanted to, and you only get you get a tax reduction in the next year. What else can we be doing at this time of year? What else do we need to be doing in terms of our annual sort of housekeeping?
There's this phrase called tax harvesting, which is I've stolen from the Americans, and after the last couple of years that we've had, with stock market investments in particular, but actually it applies to any capital assets. So it could be a property or property companies or anything. If you're sitting on investments that have lost money, and you've got some other investments that have made money, and you want to restructure or rebalance your portfolio, consider selling some of the profit-making investments at the same time that you sell some of the loss-making investments. And so let's just say you've got one investment that over the last decade has made you 100,000 rands worth of profit, and you've got a couple that have lost you 100,000 rand. You can actually sell both of those at the same time and not pay any tax, not pay tax on the gains, because you would have paid capital gains tax on any profit over 40,000 rand, and then the loss-making investment offsets that profit maker. So in fact, you could actually sell one investment or anything, all investments for 100,000 rand loss, and realize 140,000 rand profit. Now I'm not suggesting that you do this just as a matter of course, that you trade your investments. This is not for speculators. This is where you say, I've got a portfolio. I would like to have 60% in shares, 40% in bonds, as an example. It's gone out of line. Some of my investments have lost money in that mix, and I want to get the balance right. And if you hold an investment in South Africa for 3 years, then you are certain, the trigger is 3 years, then you're certain that it's capital gains tax. You don't get treated by SARS as a trader,
Yep.
where they now then tax your gains as income tax, which is a disaster. So hold investments that you've held for 3 years or longer, and this is about rebalancing and maybe throwing out the odd lemon that you've bought that you thought was going to do incredibly well. I'm still eating my listed property investments, and so selling those in a time like this where I think, actually, I just made an outright mistake. It's not going to grow for the next 5 years. I'm going to sell it and choose to do something better with it.
What happens, though? I mean, it goes back to Warren Buffett, who says opportunities present themselves when great assets are mispriced in a market. You may have an investment that is not a bad investment. It's just mispriced. Could you gamify this slightly, where you've held an investment for 3 years? It's been a disappointment. It's been a bit of a dog. You've lost 40%, but you've made 40% elsewhere. So you sell the underperforming one as well as the one that has performed well. They net each other off. You don't have a capital gains tax problem. And then on the 1st of March, buy back into the underperforming asset because you believe actually it will continue to perform. It's simply mispriced at the moment.
Yeah, I think SARS, SARS, if you're not trading, in other words, if you then hold that investment for the next 3 years,
Yep.
from March onwards, it would be very tough for them to say you're now a trader. You're sticking to the rules. So there might be some benefit in that. I don't think there are many of those kinds of opportunities. So I'm just scared while we're talking. I'm thinking, we're going to be encouraging a whole generation of traders, and we're not doing that.
Please don't speculate. Please don't do silly things. But it's just a case of there is an opportunity here for this tax harvesting, as you put it. It's a sensible thing to do. I mean, you really are not obliged to pay a penny more tax than you're obliged to pay.
Yeah. And a lot of the time the conversations now are something like, I bought this thing for 100, it's worth 60, I can't bring myself to sell it, I know it's not actually a great investment. I'm saying that's rubbish.
Utilize it as an opportunity.
Take advantage of an opportunity to restructure, make some lemonade out of the lemon that you've bought, and then understand that the 60 rands worth of value you've got today, it's about saying, where am I going to get the most growth in the future? So for me, that's a very nice trick here, is what do I do next with the money? It's not just take advantage of the tax break and do nothing. I'm taking advantage of this tax advantage, the tax harvesting, so that I set myself up for the next X years.
And please just do it properly. If you're capable, do it yourself. That's fine, but there's got to be a paper trail. You've got to be able to account for this accurately. So get a financial advisor involved, get a tax accountant involved as well, because it's critical to represent what you have done absolutely clearly, so that there can be no questions and no quibbles.
Yeah. And I just think, a lot of people were kind of not conned, but they bought into that, fourth industrial revolution kind of a trend, the tech company trend, and lots of people bought those shares and ETFs, and they've lost a heck of a lot of money. And so that might be an example where you go, okay, I've learned a lesson. I shouldn't be so specific in a particular thing. I need to be more diversified. Let me rebalance now. And take the tax knock, as a benefit to the losses that you have made.
Mike's got a question for us. Says, does it make much of a difference growth-wise if I rather wait until the end of a tax year to invest a lump sum into my RA, or should I rather set up a smaller monthly debit order? It's this old one. I once went against your advice on this, and I put a lump sum in, and the three, it always happens. I don't know why, but it feels like March, April, May, markets just go into decline when I put lump sums into a retirement annuity, and I did it, and then immediately regretted not listening to you.
Didn't the old stockbrokers say sell in May and go away? And so I'm not sure if it's true, but
not last year was not true.
Yeah.
May last year was a pretty good month, actually.
So I think from a discipline point of view, just doing a debit order every month also averages your costs in or out. So you don't get the potential for a loss where you put the money in, in Feb of this year, and then the markets fall apart in March. That potential is much smaller. So I like it from that point of view. But the other side of the story is, if, for example, you store that extra cash for the year in your bond where you owe money on your home loan, and you keep that money in your home loan for a period of time where you're then paying less interest on the home loan, and then you take it out and put it into your RA, there's a good argument for doing that. And that's a legit, a great way right now when interest rates are high to save a bit of interest and then put the money in. If it's me, I'm just doing a debit order to the maximum I can sort of afford, and just get it done so I don't forget and I don't get caught up in some kind of a lump sum trick where the market falls apart the day after I make the investment, which is usually what happens to me too.
Yeah, it's just one of those stupid things, isn't it? You get caught up and get caught out. It is about maximizing the opportunities that are open to you. Look at those. And tax-free savings accounts, you could do one for you, one for each of your kids. You can do one for your spouse as well if they're not doing it themselves. But that's as far as it goes. You can't do one for your cousins or your parents or anybody else, not for your benefit anyway. This goes directly to their benefit. And also, don't use money that you might need next year. In the next tax year, don't sort of put the 36,000 rand in thinking, hey, I'm winning, and 6 months time go, oh yeah, I needed that for a deposit for a car, and take it out again, because that really messes with your tax-free account mojo into the future, isn't it?
This is your 10-year money at least. This is the money that you plan to let it grow for at least 10 years, and please don't store it in cash. The fact that you can earn the interest in that investment tax-free doesn't mean you should. You need to kind of go for high growth investments. Shares are kind of always going to be your best option, I think, over long periods of time. So certainly that for me is a good call. It is a no-brainer. If you've got the money, please take advantage of these tax-frees. It's such a great gift. It's starting to build momentum. You're seeing more and more people actually starting to build up really nice money and engaging with the investments because of it. Great initiative. Don't sit on the sidelines going, I'm too busy, whatever. You're costing yourself unnecessarily.
Because you will pay capital gains tax on investments in the future. And if anything outside of this tax-free account structure, and I can't imagine that there won't be increases into the future where it'll go from 500 to 700 or 800 or whatever the case is. This government doesn't want to be seen to be favoring wealthier people, but at the same time it does want to remove a future burden of people relying on the state at some point in the distant future. So, yeah.
Anything we can do to get people to invest, for me, we should do. It doesn't matter how much right now. We need to get more people investing in our country, in our economy, and this is one of those.
Warren Ingram at Galileo Capital. Thank you.